Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Monday, May 24th, 2010. Let's start this broadcast with a look at the euro-dollar pair, which fell in today's trading, shedding around 61.8% of its recent rally that we had seen to end last week. We found support at the 1.2340 level as we entered the New York session, but the bounce from the losses overnight were rather minimal, with the pair testing its 100-period moving average. The main story overnight was the takeover by the Bank of Spain of a regional savings bank. Spain's central bank seized the bank Caja Sur, which had 13 billion euros in loans and held a marginal 0.6% of the total assets in the Spanish financial system. Caja Sur was considered the weakest link among the savings banks, and its solvency had deteriorated significantly by a fast-growing pool of souring real estate loans. There's two ways to read the story. One is that Spain's banking sector is in trouble, and that Spain will have to spend lots of money in further bailouts and restructuring, in addition to its other problems such as the 20% unemployment rate as well as the widening budget deficits trying to get under control. In a second interpretation, the move shows some resolve by Spanish officials to go ahead and restructure weaker parts of their banking sector, which need more consolidation in order to be more effective. The Spanish central bank said in its release that the failure of the bank won't affect the Spanish banking system as a whole. But as I mentioned, experts warned that without further consolidation in the sector, the current squeeze on credit could tighten still further, potentially worsening Spain's economic stagnation and adding to worries that investors have regarding the Eurozone periphery, including in Greece and in Portugal. Anyway you interpret it though, it did set off some jitters in the markets, which caused the euro to fall in favor of the greenback. We'll see if the selling pressure on the euro continues, though we do have support at the 1.23 level, which was our lows in Thursday's session, and below that at 1.2150, which was our 4-year low for the pair. In a look at the pound-dollar pair, we saw a similar dynamic in terms of price action, with the pound-dollar falling in overnights during the European session in favor of the greenback until it tested support at 1.4350. In New York trading, though, we did see some risk appetite returning to the markets, which helped the pound to pair some of its earlier losses as we reached the 1.4440 level around 2:40 p.m. Eastern Standard Time in New York. Zooming this pair out a little, we do see, however, that we remain within a rather well-defined trading range, with 1.4527 as our resistance and our low around 1.4230. So today's action remained well within this range we've seen the last 5 sessions. The bullish signals for the pair would be that we've had 3 higher lows in a row, but still we need to see what happens if we reach this resistance level in terms of any kind of bullish move for the pair. Turning to some fundamental news. From the US, we had existing home sales for the month of April, which showed a rather strong 7.6% rise compared to March. That meant an annual sales pace of 5.77 million, which was better than expectations and the best reading since last November, which you could see on the chart here. The rise in sales comes as the government's tax credit for home buyers is set to expire. The $8,000 tax credit ends in June, with the buyer having signed the sales contract by April, and the sale must close by June 30. So similar to November, we see the surge in sales coming prior to the expiration of the tax credit, and we'll see if we have a similar drawdown following April's reading. One thing to note from the release as well was that inventories rose by 11.5% to 4.04 million units, which is an 8.4 month supply at the April sales pace, which is likely to be a peak for the next several months going forward. The rise in inventories could have been a result of homeowners putting their houses on the market in an attempt to see if they could sell their homes as the tax credit was coming to an end, and those same homeowners may be taking their homes off the market before winter. So that could be a temporary rise in inventories, but still something to keep an eye on, as a high amount of inventories would mean that housing prices continue to be pressured somewhat. U.S. equities opened lower than the main indexes paired most of their initial losses, but then in the afternoon in New York time they did decline once again. If we take a look at the dollar-yen pair, we do see that the dollar gained against the yen, though it was a rather small increase, as the range for the total move today was around 70 pips, 70 to 80 pips. Still, we did move above our 50-period moving average, and if we show a Fibonacci of our total fall from last week, we see that we now test a 38.2% retracement. So coming into this week, at least we do see some signs of risk appetite, or at least no further signs of heavy risk aversion like we did see to end last week. Last week, commodity currencies were a very important story as they were sold off on fears that the spread of a weaker global growth, a result of the financial crisis spreading through the Eurozone as a result of its sovereign debt situation. In today's trading, for the most part, we saw commodity currencies either trading sideways or gaining slight. The USD CAD, which we're looking at here, moved in favor of the Canadian dollar, testing the 1.0530 level as its low, but making 3 attempts to try to test the 1.0550 level. This could just be a correction to the rally we had seen in favor of the greenback. If we measure the full rise of last week in favor of the greenback, we see that we are testing the 38.2% level as well as our 100 period moving average here. So we'll see if there is enough momentum for the Canadian dollar to actually move below this level, further correcting this rally from last week, or if we find support for the pair and further gains for the greenback. Now a lot of that will depend on how investor sentiment shapes up for the rest of the week as well as oil prices, so that'll be key for the direction of this pair going forward. Taking a look at another commodity currency pair, here's the Australian dollar against the US dollar, and we see that it traded for the most part higher and in the top half of the range that we had seen from Friday. But resistance from Friday at 0.8350 did hold during today's session. We did move above the 50 period moving average for the first time in the past 6 sessions in this pair, so that could be construed as a small positive sign that the pair has stabilized. Again, how investors feel about risk will be a major factor in the coming sessions, with a return to quote-unquote normalcy, giving the Aussie some chance to perhaps pair further this steep decline we had seen last week. Of course, any new developments that send strong jitters through financial markets could extend losses we saw last week. Last week we did see rather strong risk aversion as investors tried to shed as much risk as they could, and that even translated into gold prices falling sharply following their very strong rally earlier on in May, end of April and early May. But we did see this correction, but it seems that the 1165 level was our support, and gold rallied in overnight trading and as well in the New York session. So there are further bids for gold after hitting this low that we had seen on Friday. That could mean that the panic in markets that we had seen last week have calmed, and now investors are again reloading into the gold trade. So besides the euro falling, we did see some signs of risk appetite in our commodity currencies and in dollar yen as well as in the pound. So now let's turn our attention to some upcoming fundamental releases. Tonight we get data from New Zealand on inflation, while overnight we get measures from Switzerland on its consumption. The UK will post revised data of its first quarter GDP as well as an index of services and a measure of mortgage approvals, while the Eurozone releases data on industrial new orders. Tomorrow in the US we get 2 measures of housing prices, the S&P Case-Shiller 20 City House Price Index as well as the government's FHFA monthly house price index. Also tomorrow we get data from the Conference Board on consumer confidence as well as from the Richmond Fed on their manufacturing activity index. And that will conclude today's broadcast. I want to thank you for watching and wish you good trading.